I come from the Commission, like the previous speaker. We work for the legal service, and for 10 years I worked in the competition antitrust department of the legal service, and now for 2.5 years I've been dealing with state aid. We represent a number of cases, and we can give you first-hand experience, information about the jurisprudence in this area. So that's why I came to tell you a bit about what we learned from the courts in the recent times on an essential aspect of state aid, which is selectivity. So I realized that I should have come yesterday because there was so many nice presentations on state aid, which I would have loved to hear. But I will do my best to complete all those good speakers. And the issue which we have today is a fascinating one because many aspects arise in the context of selectivity. So let's get into it. What is selectivity? I started the basics. We have the definition of state aid in Article 107.1 of the treaty, and I will just read it out, okay? So, save as otherwise provided in the treaties, any aid granted by a member state or through state resources in any form whatsoever, which distorts or threatens to distort competition. And here comes the interesting bit. By favoring certain undertakings or the production of certain goods, shall, insofar as it affects trade between member states, be incompatible with the internal market. So I hope you were counting, because there was at least 6 conditions in this one sentence. And they are, first of all, the unstated one, but which comes from the case law, namely that you have to have an undertaking or an economic activity which is at stake. So natural persons or the public power of the state, which is not an economic activity, fall outside of this. The second is that it has to be imputable to the state, relate to state resources. You all know this, but I'm just putting the whole selectivity discussion in a context. The third, we need to have an advantage. And the advantage is not the same aspect, or let's say it's one side of the coin, whereas the other one, which we will talk about today, is selectivity, that it is to certain undertakings only and not generally available. Finally, there's the distortion of competition and effect on EU trade. So altogether, the 6 conditions of state aid, which sometimes are formulated as 4, many ways exist in state aid, but we all mean the same. Now, on selectivity itself, one handy summary of the Commission's and the Court's practice can be found in the Commission notice on the notion of state aid from 2016. And as a judge, I assume that it is a useful document for you to refresh or to rely on the main notions of state aid when dealing with it. At the same time, please be mindful that this is only a Commission notice, not in any way pretending to be the authentic interpretation of the case law. So if in case of doubt, it's the Court of Justice's case law, which is the authentic and the real source to follow. Now, I mentioned that notice, and in reality, it does give us some hints what selectivity is about, and it relies very heavily on the case law, of course. So, in what sense can we talk about selectivity? There is selectivity in the material sense, which means that an advantage favors certain goods or certain the production of certain goods or certain undertakings only, meaning that it is not available throughout the whole economy of a member state. The other aspect of selectivity can be a regional selectivity, when it is only available, a certain benefit, advantage, a scheme you can imagine, is only available in certain part of the country. And here you can think about, for example, local taxes or something applicable only to a particular region of the state. So in order to determine whether something may be specific to a region, one has to apply the case law of the court developed in the Azores case law on that, which you can find as described in that notice. How much autonomy that region, which set those rules, in that case it was about tax rules, how much autonomy that region has. And if it is an autonomous region setting its taxes, then it is not a derogation from a wider applicable tax regime in a country. Therefore, it is not selective. So you can think about selectivity in the material sense, what sort of activity, economic activities at stake, or the territorial sense. And there are also some case-specific situations when you apply selectivity to very complex issues such as taxes, and I will get to that a bit later. Now, selectivity can arise in the context of an individual measure, and in such a case, when only one undertaking obtains it, normally it should not even be a question, because if it is not even a scheme, which is generally open to all the undertakings, but just an advantage given to one economic operator, in such a case, the selectivity of that particular measure can be presumed. On the other hand, when you have a general scheme which defines objective criteria for undertakings to benefit from it, there the selectivity depends on whether there is any discrimination being applied between the different categories of undertakings. And I emphasize the word discrimination, because this is, as follows from the court's case law, this is the essence of what we are analyzing under the notion of selectivity. We have a number of undertakings in a comparable economic situation, and certain of these undertakings obtain a benefit, whereas others do not. How can we translate this into practice? In general, discrimination is an age-old principle. How can one set it in application for a particular state aid measure? For this, the Commission, since 1998, and then the court's case law gradually has taken over a so-called three-step approach. I'm probably preaching to the converted because you all know what it is. But nonetheless, I will still tell you these steps. One has to define a reference framework in the context of which the comparison has to be performed. So, as I said, selectivity relates to, is there a discrimination? And in that context, one has to establish the framework of the comparison. Of course, it's not easy, and we will then go on to the court cases which have illustrated these steps later on. But staying on the level of principles, this is just the practical first step, to look at what the whole system is about. Then one needs to establish whether, in light of the objectives pursued by that system, and you can imagine a system of taxation, you can imagine also just any other aid, such as agricultural aid, for example. So, in light of the objectives of that system, is there at least a prima facie discrimination between companies which are in an equivalent situation or similar situation, and which should normally be treated equally? Okay, so that's the second step, when one defines or tries to establish whether certain undertakings have been treated differently. And there is a third step to this, of course, which can result in the lack of selectivity, namely that even if one finds certain discrimination prima facie on the first look, that there is something which differentiates companies which are in a similar situation, one would still find some reason related to the general nature and functioning of that scheme, or an objective which that whole system pursues, which may justify that discrimination and remove that seeming prima facie conclusion on a discrimination. This is because sometimes when one defines a system of comparison, when applying it to real life, that there are certain adaptations which are necessary in order to make that cover all kinds of situations. And as long as these adaptations pursue ultimately the same aim, the same purpose as the general rules, they are able to justify that particular seeming exception. Okay, so much for the three-step test. I hope it's clear. If something was not coming through, please tell me to stop. And at some point also the organizers may tell me how long I may go on, because I was a little bit... Okay, I have 10 more minutes. Okay, thank you. But I don't want to take away your break either. So one can approach this selectivity analysis also from a simpler, let's say, an older method which existed for it instead of the three-step test, was the so-called general availability test, which is, let's say, still somewhere to be found in the case law. Certain advocates generals try to bring this notion back, although I must say by now we had categorical rejections of this by the Court of Justice. Nonetheless, I present you this notion. So as long as the measure is in principle available to all undertakings, they would not be discriminated by it, that there is no selectivity involved. However, the difficulty with this general availability test is that it may nonetheless allow for inherent discrimination between companies. And so the two notions compete. One notion focuses on, is there a discrimination, in essence, either de jure or de facto. The other notion is the availability. Could, in principle, an undertaking, if they change their activity, for example, be eligible for that kind of aid? And if that's the case, if there's no, let's say, legal obstacle for an undertaking to modify its business and to obtain a certain benefit, then it would not be considered selective. The court, it seems, has opted for the analysis of discrimination. So the general availability is not a reason which is followed in case law in recent judgments. But I mentioned it to you because certain advocate generals like to refer to it. Now, there is already difficulties at the very first step of the three-step approach, which I mentioned. So how to identify a reference framework. And this, of course, depends on what kind of a measure we are analyzing. If it's a tax, you can think about the general taxation of the whole country. And when you have an exception, a derogation from that tax, then one has to set it in the context of the wider taxation. On the other hand, you may have a special tax. For example, a tax on multinational companies only, because they have money. And is that part of a wider general taxation one has to look at, or only a specific tax on multinationals because we have a crisis and we want to generate some income? That's it was a rhetorical question. But the Commission has a view on that, and we have analyzed recently the Polish, Hungarian, and Slovak cases on turnover taxation of undertakings, multinational companies especially being hard hit by this with a progressive turnover tax. And in that context, it is the reference framework is the tax itself, because there is no wider tax, for example, tax on VAT or income tax, of which this specific tax would form part. So one has to look at this tax on its own. Just one illustration why it is difficult to define the reference framework. It is important to bear in mind also that not all kinds of objectives can be taken into account when defining such a context within which we compare. Normally, the reference framework should be logical and coherent. One cannot establish a system of reference which is full of holes. So let's assume that there's a general rule and there are 50 exceptions to it, and to say that we define the framework like that, including all the exceptions, that would not really make much sense. But the test of the cake, the pudding is in the eating. So we we do not have a general rule which is applicable to every single situation, and we face this difficulty in every single case we deal with, how to define the reference framework. And we are following closely the guidance in this regard of the courts. We received some guidance, although it comes in small bits. For defining this reference framework, what we know from cases such as the Sanierungsklausel is that the Commission, or just any authority, should not be too formalistic when one tries to apply the rules, when the regulatory technique by a member state, whether they give derogation, an exception from a general rule, or simply defines the rules in such a way that they lead to a discrimination by themselves, should not make a difference. So the regulatory technique is not essential. Just because one calls something seemingly a derogation, an exception, it's not the decisive point. That's one takeaway from the case law. Another takeaway, which we have learned, is that when defining the objectives of a reference system, one needs to look at, especially when one talks about a tax, it's the fiscal objective of the tax which matters. What was the main purpose pursued by that tax? We can refer here to the A. Judgment, which at least put some consistency in the application of this method, and that showed that even if there are other objectives one may think about, in that judgment it was the avoidance of double taxation, or having a disproportionate taxation, that sort of a second objective had to be taken into account, not at the very first step of defining the objective, but at the last step, as a justification of an already established discrimination, prima facie discrimination. I know it sounds a bit Chinese, what I'm saying. It's because the courts themselves sometimes struggle with this notion and sometimes define certain objectives as removing even the notion of discrimination already in the first or second step. This we saw, for example, in the Anget case, where we not only had the objective of a tax, is the fiscal objective to generate turnover, but we also had the purpose of that tax, which was to save the environment and to fulfill certain town planning objectives. So when that judgment applied those objectives, which are not the same as the, let's say, the main fiscal objective, in that judgment, interestingly, they were elevated to the same level and applied at the same time, meaning that companies which were discriminated to fulfill those environmental or town planning objectives were not found even to be even prima facie discriminated. So I hope you see the difference, that you can either follow the method that you establish a prima facie discrimination on the basis of the main objective of the system, and then later on find a justification for it, or you already say that they are not even in a comparable situation. And this is often a very, very difficult exercise, but at least the practice of the Commission is, when faced with any kind of a measure, and especially in tax measures, is to look at the main objective, which is a tax's objective is to collect money, and any sort of a derogation or different treatment for any particular reason is analyzed at a later stage can it be justified? And the end result may still be that it is non-selective and justified, but it does matter, and it's very important in which step we reach that conclusion. Because if we mix all the objectives together, the definition of the reference framework with the justifications within the first step, then the burden of proof, who has to prove what, becomes very blurred. Normally it works this way, that when the Commission or any claimant before your courts claims that there is a selectivity in a measure, the prima facie selectivity is proven in the Commission's case by the Commission itself, by saying here we find a discrimination because a company is not treated equally as another one, seemingly. Now, then it becomes a task of the member state to justify why that different treatment was done, and there can be such reasons which relate to the nature, the general logic of the system, and in which case then that practice can be, in a final step, excused, that there is no real selectivity in the end. Okay. So I talked about the identification of the reference system, which is a difficulty. And you can understand how difficult in real life it is when you understand that there are multiple objectives followed by a measure. And again, we return to the issue of taxes. A tax can be imposed simply to collect money. But there's also some social aspects when one follows in imposing a tax. It can be a redistributive purpose. And this is an interesting debate. I just wanted to flag it to you that right now the issue of discriminatory turnover taxation is a hot potato. The Commission has been recently annulled in a Polish case, and we also have 2 preliminary rulings before the Court of Justice on this very topic. The turnover taxes, which are developed in a progressive manner, that result in a discrimination according to the Commission. The Commission's point of view was, in such a case, that by the design, the very design of that system itself, resulted in a discrimination. It's not that a particular derogation, exception, existed for a certain group of undertakings, but it was designed in a manner that by the progressivity of the tax, certain companies which are in a similar situation as others had to pay less tax. And there it becomes really an issue of, can turnover be such a factor which can lead to discrimination in such a case? A company with a large turnover, are they in the same situation as the company with a small turnover? So that is still to be decided definitively by the Court of Justice. You may watch the judgments in the Vodafone case and the Tesco case. Both of them relate to a Hungarian turnover tax. On a more general note, I would like to, I know I'm coming to the end of my presentation, but just so you realize how much in motion this whole debate is, last year we had 5 very important judgments on selectivity, and what is interesting is that they touch basically the heart of this essential notion, which one would think we should know by now after so many years of state aid experience by the courts and jurisprudence. We should know what selectivity means. And yet, when faced with certain difficult situations, especially in the tax area, we find that even experienced authorities like the Commission is annulled at times because simply the court has a different understanding and would like to refine further this very notion. So just to mention those judgments, and then I will stop. So we had, for example, the Anget case, which I mentioned to you, where we found out that various objectives can be inherent, intrinsic objectives within a system of reference. Before that, we thought that there was mainly the fiscal one. Turns out that environmental or other can be also intrinsic objectives. Then the Ajutoarelor judgment was an important one, which confirmed the application of this three-step method, which I told to you, and focused on the main objective, whereas the other objectives were used in the third step, the justification of an established prima facie restriction. We had the Commission versus Spain Spanish leasing case, which rejected the so-called general availability test, which I told you about. We had a case sent back to the General Court after a series of annulments, this Spanish goodwill, where finally the General Court also agreed that the measure was selective and not justified. We had an important case called Sanierungsklausel, where it was about the selectivity of a tax measure, and that related to how we define the reference framework. If a particular exception, derogation, is following the same aim as the general scheme at large, then it is, again, non-selective. And from my presentation, you could see that there are many issues still to be decided or clarified by the courts, but the latest, let's say, hot topic is this progressive taxation. Not the least because it affects a huge amount of revenue, and it has become fashionable to hide behind the fiscal autonomy of a state to define such taxes. And the debate is far from being over yet, so this is something to watch. I hope you could take away something useful from my presentation. If you have any questions,
The corporate tax in a certain country which says, well, companies having more than 10,000 employees, they have a lower corporate tax, and it happens that there are just a few of those companies, like 2 or 3 or 5. Would that be selective?
It depends. The number of companies is actually not the essential aspect here, but how you define the reasons for which they should get a lower tax. If it is based on an objective criteria, for example, that for the purpose of the tax itself, it would not make sense to tax them. For example, in VAT, you have a threshold until which it doesn't apply. Sometimes it can be the costs of collecting a tax which exceed the expected revenue. So it makes sense even for a member state not to impose a tax on smaller companies, because even from a fiscal objective, it will not generate enough turnover to go through this whole taxation exercise. So if it is aspects like these, which justify the, let's say, the non-taxation or the different lower taxation, then it would not even be prima facie selective, but in any event, one could find a justification likely at the end by the nature, the logic of the system.
And what if there is no explanation in the measure itself? Can the member state bring explanation at the stage of the court procedure?
Well, this is again an interesting aspect of the Vodafone case I told you about, because in that case it was about turnover taxation. The member state relied on simply ability to pay. They said that companies with larger turnover have a bigger ability to pay. And then, interestingly, the Advocate General's opinion, Madame Cocotte, said that what the member state in reality was pursuing was something else, namely that larger companies usually engage in tax avoidance activities, so it is easier for them to reduce their profits in a certain country. Just an illustration to say that normally all those justifications which explain why certain undertakings are treated differently should be during the administrative procedure if it's a commission case, or it should appear from the measure itself. Nonetheless, the courts can interpret this, and there is no final judgment yet. But all I'm saying is that there are other aspects which may inspire the court's thinking in this regard. Of course, when one puts it in the context of the burden of proof, and that it should be the member state who proves adequate justification for prima facie selectivity, then normally this should not be allowed. But in a very sensitive, delicate topic such as taxation, when millions of euros are at stake, just a formal mistake of not relying adequately in a provision of a law about a principle, we will see if that is very relevant or not.